All right, so hey everyone, this is Raymond. I'm one of your co-captains for EconUnited, and for this month's February monthly meeting, we're going to be talking about the psychology of investing. A quick little table of contents and overview onto the things that we're going to be talking about. So we're going to be talking about four main subtopics, which is four main sections. And the first is the illusion of control. Next is the loss aversion. Next is fear of missing out. And finally, we're going to be talking about confirmation bias. These are the four main topics that we believe fit the overall topic of the psychology of investing the most. And I hope you guys enjoy this lesson. Starting off, we're going to talk about the illusion of control. So essentially, what is the illusion of control? Basically, it's the idea that people have the tendency to believe that they have control over a random set of outcomes that they truly don't have control over. So in investing, this can be a multiple of issues, such as over trading, excessive research, and believing that effort is greater than probability in markets. Essentially, why people do this is because when they believe that they can control a trade or control a specific asset and influence the price of its and have influence over the price of its outcomes, this can lead them to over trading, putting in which can lead to excessive fees. They can have a higher chance of losses since more trades correlate to greater losses generally. And then they do excessive research. Essentially, what this means is that they research a stock or an asset multiple times over and over again in order to find information that they believe gives them an advantage, or in order to believe that they have an edge just because they did quote unquote preparatory due diligence. And this overall makes them believe that effort is greater than probability in markets. However, this is simply not true. Markets are extremely complex, and it's almost impossible. It's pretty much impossible in order to actually predict markets or be able to get them right consistently. So a lot of the times, the illusion of control can lead to people, having bigger losses. It can lead to them holding more or burden on their portfolios because over time, indexing in general is just a better bet to go with. So how does this appear in markets? So this could appear in three different ways that I think are the most prominent. First, it's day traders trying to time the market, people overreaching information about a stock for proof of due diligence. This is this is sort of covering confirmation bias, which I'll go over in another slide in like future slides. And investors believing chart patterns can consistently guarantee outcomes. This is called technical analysis. So first, starting off with like day tradings, trying to time the market. Essentially, what this is because people who put in multiple trades each intraday, they believe that the patterns in which they buy and sell at are capable of being able to predict the actual price fluctuation of an asset, meaning that they can make extraordinary returns or they can sort of quote unquote beat the market. Essentially, instead of buying and holding an asset and waiting for it to appreciate over time based off of fundamentals, day traders believe that they can buy and hold assets intraday in order to make profit off of it in the short term. Next is people over researching information about a stock for proof of their quote unquote due diligence. It's also called confirmation bias. Essentially, what this is people are going to start researching about a specific asset purposely to find good information or good news about it to help justify their actions about buying an asset or holding it. Now, this also doesn't have to be just for buying. It can be justification for selling an asset or justification for making any financial decision that they do. All can fall under confirmation bias or people over researching information in order to prove their due diligence. And the next is investors believing chart patterns can consistently guarantee outcomes. This comes with technical analysis. So essentially what this is that they draw lines based off of patterns on a specific asset price, and they think that these lines are going to be able to consistently predict or consistently guarantee outcomes in a specific asset's price or the overall market. And essentially, this is just not true. Even if it works maybe one or two times, over time, over a long period of time, it's not going to work consistently enough for you to make returns that are actually profitable, or at least more profitable than if you were to just index or were to just take a more passive approach into investing. And there's also a heads up. Empirically, studies have consistently shown that active traders underperform index funds long term. there's actually an active correlation between more trades and lower average returns over time. So this means is that the more trades people put in, meaning the more buy and sell that they do, correlates with less returns, with lower average returns over a long period of time, which is why there's a lot of financial advice out there. And this is not financial advice, by the way, but there is just a lot of like empirics and a lot of just information from credible sources and other like educational institutions that say that index funds over a longer term consistently will always outperform active traders. And a lot of the times when people sort of try to misconstrue this narrative, they say that, oh, well, certain funds, certain people, institutions have been successful with trying to time the market or trying to get outsized returns relative to the market. However, they don't realize that these are institutions with a ton of resources and some of the most smartest and some of the best talent in the entire world. The things that they're able to do with the resources that they have are not replicatable based on the average person or even a group of people. They're not going to be able to replicate the same things that these major institutions are able to do simply because they don't have, simply because finding this talent is very hard. And not only that, but it's also super expensive to start when you have all of these devices, all of this technology, and all these complex algorithms that you need to build. So in this next section, we're going to be talking about loss aversion. So quick little overview about the psychology and definition. Essentially what loss aversion is, it's the tendency for individuals to feel the pain of a loss more strongly than they feel the pleasure of an equivalent gain. A couple facts about this is that losses psychologically feel about 2x more painful than gains feel good, and that the concept of loss aversion was coined by Daniel Kahneman, which was a famous psychologist and a behavioral economist, as well as Amos Tversky. Simply, the reason why this phenomenon called loss aversion sort of tends to spiral out is because losses tend to trigger a survival mode instinct, or sort of a flight or fight response in the human mind, which we become more stressed, more anxious, and we become more avoidant of losses because it directly, in our minds, it directly triggers a survival instinct, or it makes us feel like we're in danger even if we're not. Well, when we gain, the pleasure response from it is often caused by the release of dopamine or serotonin and other hormones that tend to be short-lived or tend to just be like a quick hit relative to losses, which can feel psychologically and even just physically overwhelming. If you look at the effects that stress has on our body, it generally can be physically overwhelming, not just psychologically. It doesn't just feel psychological effects for a quick second. Versions show up in investing? Well, it can materialize in three main ways. First, it's holding losing stocks. Next is panic selling. And the third is chasing quick wins after losses. Essentially, what holding losing stocks means is that investors tend to refuse to sell because selling makes them realize their losses. Essentially, what this means is that before an investor has sold, the losses that they see are technically unrealized, meaning that they technically have not lost anything yet in terms of the financial value of the asset. Actually, they haven't lost the real value of it because they still have the same ownership claim. However, they have lost technically when you look at the financial value of the overall asset. However, when you sell them, it makes them fully realize both parts of it. If they realize the loss on both the real and the financial side. Essentially, what this does is that even if this asset continues to underperform in the future or is looking bad right now, investors tend to hold their money in here because it helps to sort of calm their ego, and it helps to sort of makes them feel more self-esteem and less worried about it, even if the more rational decision would be to just sell and diversify into another assets. Essentially, what this ends up causing is that it ends up trapping capital in underperforming assets. The next is panic selling. Essentially, what this is that sharp declines in the market triggered by one-off event or one-off news can trigger fear responses known as the fight or flight response, where investors sell to avoid the emotional pain of having or seeing unrealized losses. However, the short-term relief of this can actually cause long-term damage, as maybe you're going to sell right now. However, but even in just a short or over the long term, when markets and indexes tend to recover over time, but you no longer have an asset or a position in it because you panic sold at a time where it didn't wasn't necessarily warranted. And the next thing is obviously chasing quick wins after losses. Like we mentioned in the previous slides, losses feel worse than gains feel good. So whenever we have a tiny losses, we tend to overcompensate in this by trying to make this back, and then once we do, we try to make more of this. However, as also mentioned in the slide where we talked about the illusion of control and of the ability to influence markets, there is a huge correlation between more trades and lower average returns over time. Essentially, what this means is that it's actually very unlikely, or it's very hard for quick gains to offset losses that you already incurred. It's much better to reposition your strategy and to change the way that you do, or to change your behavior in order to make this back long term in the future, instead of just chasing short gains and short returns that often are not sustainable and often do not even materialize in the first place. And then this is just a quick little demonstration on how loss aversion can sort of occur in market chaos, about the three different things. So this one's mainly looking at panic selling, and it looks at how panic selling sort of brings out. So during major downturns, fear spikes in the markets as media coverage tends to intensify negative sentiment, as this draws attention, brings in viewership, and it just overall just makes more noise for the studio or the franchise itself. And what this does is that it causes investors to shift back into that survival mode, which we see as that fight or flight response. And it forces them to make a decision, and often that decision means avoiding losses by panic selling and other methods. So when this typically happens is that retail investors sell near market bottoms, while institutions are hedging risk and are more resistant to these psychological impacts as they optimize for efficiency and optimize like a business instead of being fulfilled by emotion. They tend to accumulate assets at a discount or at a price that is cheap. As long as fundamentals and the long-term overview has not changed, this can be seen as a great way to buy at a lower price. And the reason for this is because broader markets and broader indexes tend to recover over time, even if individual assets that have their fundamentals changed do not recover over time. All right, section 3, we're going to be talking about FOMO, or the fear of missing out. So what is FOMO? So essentially what this is in markets, FOMO is a tendency for individuals to buy an asset primarily because others appear to be profiting from it, or others are getting gains from it. And FOMO is oftentimes driven by emotion rather than logic and the actual fundamentals in a market. And there's a couple things that really fuel FOMO. So the first one is social proof. What this does is that we oftentimes look for proof that the decision that we're making is a good one. And a lot of times this comes in the proof of other people are buying it, which makes it feel safer for you or another individual to also get in. As psychological, we're thinking, hey, if other people are putting their risk at this, then look, maybe if I put my risk into this asset, it's not that big of a deal, or it's not that dangerous. And next is viral amplification. What this means is that social media often spreads rapid gains fast while the losses stay undercovered, meaning that in these viral euphorias, or these times where certain assets are going parabolic, their prices are doubling at insane rates, and in a very short amount of time, a lot of times people will push these screenshots and push these moments onto social media, and this will be spread while the losses are often undercovered, or at least less posted and less shown than the upside. The next is greed plus urgency. Essentially, this goes by the logic of, if I don't buy now, then I'll miss the opportunity forever. Essentially, what this does is that this sort of logic basically just means that is pretty much the core of fear of missing out. Saying that if I don't take the opportunity at this now, then I'm going to miss out, and I'm never going to have the choice to enter back in the future. That's the whole premise of FOMO. Here's a quick few market examples onto when FOMO tends to materialize the most, and a lot of these are more modern examples that we've seen. So first is meme stock surges. Essentially what these are stocks that are driven by online communities or niche groups of individuals that often push or hype up a specific asset in order to move the price up and to gain value from it. A lot of the times, these assets and stocks often move detached from their actual business, meaning their earnings or the amount of money that they're actually bringing in. And A quick thing about meme stocks is that these are often always short-lived, as their fundamentals and their actual underlying business do not support long-term benefit or long-term growth in these cycles. And even the people who are driving these assets up or forcefully promoting it or increasing its, the spread, tend to also realize this, but they benefit from others tagging along and sort of avoiding this sort of narrative. However, a lot of the times, everybody who's like, not everybody, but most people who are taking part of these activities do understand that these are short-lived hype cycles. However, their brains still believe that maybe they can get lucky or maybe they can catch some quick gains and then in the future they can avoid this. However, what time and time again, what this is that yes, there may be a few big winners that come out of this, but the majority of people tend to be losers and will be better off just avoiding this as a whole. Next are crypto bull runs. So these are just exponential price increases in cryptocurrency due to hype and rapid adoption narrative. Essentially, what this means is that people are saying that cryptocurrency is going to be a huge sub in for the current financial system or the current fiat currency system that we have right now. And that in the future, the prices of all these crypto assets will be insanely high. And if you adopt them right now, then in the future, you're setting yourself up for success. However, there hasn't been real evidence or hasn't been too much good confidence in the actual adoption or the widespread of crypto in the future or even in just the near future itself. So crypto bull runs often occur during broader market bull runs. Essentially what this means is that crypto tends to do good when the overall economy, the overall sentiment of the actual market itself is doing good, which means that investors are more likely to pile money into more riskier assets or make riskier bets and take chances on different things. So, for example, in 2020 to 2021, when the Federal Reserve cut interest rates, we call this quantitative easing, the cost of borrowing in dollars or the price of money in the form of fiat tends to be cheaper, which means that people and businesses are borrowing more, they have more money to spend, and people are just overall more confident in the economy. Not only this, but since quantitative easing or lowering interest rates itself makes the dollar less highly priced or drops down the value of the actual dollar. What this does is that it also adds another thing, that other currencies tend to rise because of this. And this is often what driven the 2021 crypto bull market or the bull run that they called. And the next is the AI stock hype cycles. Essentially what this means is that in recent years, companies with AI in their names or have AI projects that go in the headlines tend to see extreme valuations that are way higher than their actual underlying business or their earnings tend to support or justify. And this is often due to the current market focus on the growth of AI and potential future impacts. Essentially, what investors are betting on is that in the future, AI is going to transform a bunch of industries. It's going to be a huge part of the production of the economy and the backbone of basically the entire world. And essentially, in the future, if these things actually do end up materializing, then betting big or giving huge valuations to current AI companies might not be a big ask or might not be a big thing, even if it might not be a big thing as long as in the future they're overperforming and doing well. And this can be dangerous in a couple ways. First is that most AI companies that are, that might be penny stocks or even just small cap stocks are not going to actually outperform or are not going to adopt much of the growth that is seen in AI. That's a huge risk. And the nuts is profitability and the timeline issues. Simply, how long will it actually take for these companies in order to generate profit or to be actually useful in the real market or in the real world? And if the timeline is too long, even if in the very far future that these companies are actually able to make substantial impact and be worth their investment, it still has the ability of trapping money and growth in companies that that are going to underperform for the foreseeable future. In the final section, we're going to be talking about confirmation bias. So, quick little definition is confirmation bias is the tendency for individuals to seek information that supports existing beliefs and downplay contradictory evidence. Essentially, what this means is that when individuals make a decision to get exposure on an asset. This means buying, selling, or any other decision that gives them exposure. They tend to research and look for evidence that directly supports existing beliefs that they had or specific choices that they made on exposing themselves to the asset. And a lot of times this can materialize in them downplaying contradictory evidence or even just ignoring evidence that goes opposite of them and sort of inflating or overstating evidence that supports their decision. And what does this look like? Well, simply it can materialize in just these 4 steps. So first, an individual buys a stock, they search for bullish news to validate their decision, and then they downplay or just completely ignore bearish analysis and evidence as a whole. And the final step is that they often sort of sometimes even reinterpret negative evidence as temporary or irrelevant, or even in their own mind subconsciously see it as a positive thing in some way, shape, or form. And these are the 3 main dangers of confirmation bias. First is that it prevents objective reevaluation. Next is that it increases emotional attachment. And third is that it escalates their ability and their commitment to the asset. So prevents objective reevaluation. What does this necessarily mean? So over time, markets tend to change and the underlying business does as well. What happens then is that when individuals tag themselves to a certain asset or to a stock, and the business of that company sort of underperforms or changes in the status quo, then what happens is that their previous thesis may no longer be true. However, confirmation bias forces them to seek out things such as find information that sort of validates their decision, and it helps to avoid making them sell or avoid making them change up their strategy or admit that they were wrong. And the reason why this does is because of emotional attachment. Selling, or let's say admitting that your decision was wrong, feels like admitting that you were wrong, and the ego gets tied into these outcomes. Self-esteem and ego are one of the main drivers of confirmation bias, is that we often don't like admitting that we're wrong, and when we are wrong, we tend to find evidence or ways to prove that we're right. And this is the main thing about the dangerous effects of confirmation bias, is that we tend to avoid losers and we tend to avoid this stuff when this can generally be harmful to us and our goals, because there's real financial value and assets tied to this. And obviously this comes down to the escalation of commitment to it too. Investors sometimes double down and defend their theses, and this can lead to irrational decisions. So what this means is that when investors have a lot of research or a lot of hours poured into researching a specific asset or stock, they can sort of double down on it since their identity essentially becomes tied into it. So even if underlying fundamentals change, they continue to invest in it, they continue to defend their thesis, and a lot of the times this can be irrational even if they are right in certain decisions, because the time spent on it, the opportunity cost that they could have their money allocated in other assets can sometimes even make it so even in the case that they are right, their confirmation bias and their identity attachment to a specific stock or asset makes them overall lose in the future. So why is confirmation bias so hard to avoid? Well, it's simple. It's a huge... All right, so thank you guys for showing up to February's monthly meeting. And a quick little reminder, the links for the Olympiad and internship are in the description. I know that the deadline for the Olympiad is coming up and should be about the 20th of March. So if you want to sign up, you should probably try to sign up as soon as possible. We have a YouTube video launched explaining the intricacies and what our Olympiad offers and how you compete in it. And we also have in that video, in the description of it, there should also be sort of a deadline or like the timeline of when and certain dates are and important dates for that thing are. So also, if you haven't already, make sure you guys follow the Instagram, follow the TikTok, and if you have any questions or would like to apply for anything and have questions on it, you guys can always email the EconUnited team at gmail.com, which is our email. So thank you guys for watching this video.